Salam and good day everyone, my name is Hafiz. In this video, my team and I are focusing on the comparison of your financial ratios, which consists of 5 construction companies. The list of the company are Muhibah Engineering, Fajar Baru Builder Group, AME Elite Construction, Egovis Berhad, and WCC Holding. And this is our presenter that will be discussing the 5 financial ratios, which is liquidity ratio, activity ratio, profitability ratio, leverage ratio, and market ratio. Here is our analysis for the current ratios for the selected companies from 2021 to 2023. The current ratio measures a company's ability to cover its short-term liabilities with its short-term assets. It is calculated by dividing the company's current assets by its current liabilities. Based on the charts, Muhibah Engineering current ratios has fluctuated with a drop from 1.03 in 2021 to 0.90 in 2022. Before improving slightly in 2023, indicating that Muhibah Engineering started to have a strong cash flow or quick access to short-term financing in 2023. Fajar Baru Builder Group ratio is consistently above 2.0, but it has declined from 3.12 in 2021 to 2.33 in 2023. Although still strong, the downward trend suggests decreasing liquidity and increasing in current liabilities. AME Elite Construction Berhad maintained a strong ratios, peaking at 3.62 but dropping to 2.69 in 2023. Despite the decline, it remains well positioned to meet its short-term obligations. Egovis Berhad current ratio has declined significantly from 1.4 in 2021 to 0.9 in 2023, which indicates that a ratio below 1 in 2023 raises concerns about liquidity and the ability to meet its short-term liabilities. WCT Holding Berhad ratios are relatively stable, fluctuating slightly between 1.41 and 1.52. This indicates consistent short-term financial obligations. Based on the analysis, AME Elite Construction Berhad is the best in terms of liquidity, followed by Fajar Baru Builder Group if they can stabilize their trend. Now let's start with the quick ratio. The graph shows the quick ratio trends from 2021 to 2023. The quick ratio analysis is a critical measure of a company's liquidity, showing its ability to cover short-term liabilities with its most liquid assets. We start with Muhibah Engineering. The quick ratio has fallen slightly from 2021 to 2023. While the decline is not steep, the consistency suggests a gradual weakening in its ability to meet short-term obligations. Fajar Baru Builder Group shows a strong ratio but unpredictable, peaking at 2.35 in 2022 before dropping sharply to 1.86 in 2023, which are raising concerns over cash flow or liabilities. AME Elite Construction's quick ratio steadily declined from 1.32 in 2021 to 0.84 in 2023, falling below 1.0 and indicating potential challenge in covering its short-term liabilities. Egovis Berhad has demonstrated resilience, dipping from 1.3 in 2021 to 1 times in 2022 but recovering to 1.0 times in 2023, showcasing strong liquidity management. Finally, we have WCT Holdings with the lowest quick ratios across the board. It has gradually declined from 0.81 in 2021 to 0.76 in 2023. Remaining below 1.0 times for 3 consecutive years indicates that this company may struggle with liquidity challenge and could require immediate attention to improve its financial position. In summary, Fajar Baru Building remains strong but unpredictable. Egovis Berhad shows stability and recovery, while ME Elite and WCT Holding face significant liquidity concerns. Muhibah's steady decline suggests a need for strategic action to improve its financial position. That's all for the liquidity ratio. I will pass it down to Afifi for the activity ratio. Thank you.
I would like to present the average collection period for 5 companies from 2021 to 2023. This data is crucial for understanding how effectively the company are collecting their receivables. Let's start with AME Elite Construction Berhad. Consistently has a lower average collection period, indicating their collect payment from their customer the fastest. This suggests efficient credit and collection practice, which is crucial for maintaining high cash flow. Next, we have Egovis Berhad also demonstrate a relative short collection period through it fluctuate across the year. This still points towards efficient credit management. Muhibah Engineering Berhad and Fajar Baribuilder Group Berhad have longer collection period, indicating potential challenges in collecting payment immediately. This could tie into the nature of their project, customer base or credit policy. VCT Holding Berhad consistently show the longest collection period, raising concern about their credit and collection procedure. This could lead to cash flow problem and increased risk of bad debts. In summary, AME Elite Consortium Berhad appear to be the best performer, consistently collecting payment much faster than its peer. This suggests strong credit policy, efficient collection procedures, and potentially a strong customer base. Next, we go to the fixed asset turnover ratio. If you can see, the chart shows the 5 nation construction company from 2031 to 2033. This ratio reveals how effective a company use its fixed asset like property, plant, and equipment to generate sales revenue. A higher ratio generally indicates better efficiency. Let's start with EcoVest. Consistently demonstrate the higher fixed asset turnover across all 3 years. This suggests they are the most efficient in converting their fixed asset into revenue. They have strong management of their asset and are likely generating strong sales for their investment. Next, we have EME Elite Consortium Berhad show a consistently increasing trend, meaning they are steadily improving their efficiency in utilizing fixed asset. This could be due to factors like increased capacity utilization, improved production process, or better sales strategy. Fajar Baribuilder Group Berhad show improvement from 2021 to 2022, but it's slight dip in 2023. This might indicate change in their investment strategy, project mix, or operational efficiency. Muhibah Engineering and VCT Holding Berhad generally have the lowest ratio. This could indicate that they have a more capital intensive operation, are undergoing expansion with newer assets not yet fully contributing to revenue, or have lower capacity utilization rates. In conclusion, EcoVest Berhad seems to be the most efficient in using its fixed asset, but a comprehensive analysis involving multiple financial ratio and qualitative factor is essential to determine the best company overall. Thank you.
We'll be discussing the gross profit margins of 5 companies: Muhibah Engineering Berhad, Fajar Baribuilder Group Berhad, EcoVest Berhad, AME Elite Consortium Berhad, and WCT Holdings over the period from 2021 to 2023. Muhibah Engineering Berhad has shown a slight increase in gross profit margin from 20.64% in 2021 to 20.70% in 2023. This suggests a stable level of operational efficiency with minimal changes over the 3-year period. While this consistency indicates solid profitability, there hasn't been any significant improvement, highlighting a relatively steady but not growing financial performance. Fajar Baribuilder Group Berhad has experienced a decline in profitability, with its margin dropping from 5.59% in 2021 to just 4.5% in 2023, which is now the lowest among the 5 companies. This decline likely signals increased cost pressures or possibly reduced revenues, which have weakened its overall profitability. For EcoVest Berhad saw a peak in its margin in 2022, but then suffered a significant drop in 2023. This sharp decline could be attributed to either higher operational costs or a decrease in revenues, which negatively impact their gross profit margin. AME Elite Consortium Berhad demonstrate a positive trend in 2022 with an improvement in its gross profit margin. However, it faced a sharp decline in 2023, ending lower than in 2021. This points to a volatile performance, suggesting challenges in sustaining profitability year on year. Lastly, WCT Holdings consistently exhibit the lowest gross profit margin among the companies throughout the 3 years. Moreover, the company experienced a significant decline in 2023, reflecting continued challenges in maintaining profitability and possibly operational inefficiencies. In conclusion, while some companies have demonstrated stable or even improving margins, others, particularly Fajar Barbuilder, Group Berhad, Ecovest Berhad and WCT Holdings face significant challenges in maintaining or improving profitability. These trends highlight the varying levels of financial health and operational efficiency within the sectors. Let's now focus on the return on asset ROA for these 5 companies from 2021 to 2023. Muhibah Engineering Berhad experienced a decline in ROA in 2022 but showed a modest rebound in 2023. However, despite the recovery, its ROA remains the lowest among the 5 companies. And this indicates that while there has been some improvement, the company continues to face challenges in effectively utilizing its assets to generate profit. Fajar Barbuilder Group Berhad saw a sharp drop in ROA in 2022 but managed a partial recovery in 2023. While the company performed well overall, the fluctuation indicate challenges in maintaining consistent returns on its asset, possibly due to external pressure or internal operational issues. Ecovest Berhad exhibit a gradual decline in ROA over the 3-year period. This trend suggests ongoing operational inefficiencies or difficulties in asset utilization, which have affected the company's ability to generate returns from its asset over time. AME Elite Consortium Berhad stood out as the top performer in 2023 with a significant growth in ROA. This strong performance positioned it as the best performer among the 5 companies in that year, demonstrating excellent asset utilization and operational efficiency. Finally, WCT Holdings saw a slight improvement in ROA from 2021 to 2022, but in 2023, the company's ROA plunged into negative territory. This sharp decline signals significant operational or financial challenges that severely impact the company's ability to generate returns from its assets. In summary, AME Elite Consortium Berhad has demonstrated impressive performance, while WCT Holdings faces substantial difficulties. Other companies such as Fajar Barbuilder Group Berhad and Muhibah Engineering Berhad show fluctuation in performance, indicating the varying degrees of success in asset utilization across this firm.
So let's take a look at the debt to equity ratio chart, which compares the financial leverage of 5 companies over 3 years from 2021 to 2023. Starting with Muhibah Engineering Berhad, the company shows a steady decline in its debt to equity ratio, dropping from 24.5 in the year 2021 to 20.09 in 2023. This reflects a reduced reliance on debt and improved financial stability. Next, for Fajar Barbuilder Group maintains a low and stable ratio, fluctuating slightly from 13.39 in 2021 to 17.08 in 2023. This demonstrates a prudent financial management and minimal dependence on debt financing. On the other hand, Ecovest Berhad has the highest debt to equity ratios among the companies, increasing from 269 in the year of 2021 to 297 in 2023. This indicates a heavy reliance on debt and higher financial risk. AME Elite Consortium Berhad experienced a peak in 2022 at 100, but significantly improved by reducing its ratio to 63.08 in 2023, and this signals an enhanced financial health and better debt management. And lastly, for the company of WCT Holdings Berhad maintains a relatively high and consistent ratios, ranging from 95.4 in the year of 2021 to 90.77 in 2023. This shows a sustained reliance on debt without a significant improvement. In summary, while Ecovest Berhad demonstrates the highest financial risk due to its high and rising debt to equity ratio, Muhibah Engineering Berhad and Fajar Baru Builder Group reflect more conservative financial practice and a stronger financial stability. Now let's look at the time interest earned (TIE) chart, which measures a company's ability to cover its interest expenses. Starting with Muhibah Engineering Berhad, we see a positive trend over the years. Its TIE increased from 1.3 in 2021 to 2.42 in 2023, reflecting better interest coverage and improved the financial health. For Fajar Baru Builder Group, however, shows a significant fluctuations. It starts at an exceptional 51.11 in 2021, but drops sharply to negative 4.85 in 2023. This decline raised concerns about the company's ability to meet the interest obligations. For the Ecovest Berhad company, consistently exhibits negative values from negative 0.574 in 2021 to negative 0.04 in 2023. This trend indicates a persistent inability to cover interest expenses and highlights of financial risk. On the other hand, AME Elite Construction Berhad demonstrates a steady improvement, increasing its TIE from 7.09 in 2021 to 0.34 in 2023, and this performance showcases a strong financial management and a growing stability. And finally, WCT Holdings Berhad remains a stagnant with a TIE of 1 in 2021 and 2022, but declines to negative 0.68 in 2023, signaling a deterioration in financial health. In summary, AME Elite Construction Berhad stands out as the most consistent and improving performer, while Fajar Baru Builder Group and Ecovest Berhad highlight a concerning trends and financial risk.
So now I will present for the market ratios. So first is dividend payout ratio. As we can see from the chart, from Muhibah Engineering from 2021 until 2023, the dividend payout ratio is consistently zero throughout the 3 years, which means that the company did not distribute any profits to shareholders in the form of dividends during this period. This could suggest that profits were reinvested or not sufficient for dividend payment. So next is for Fajar Baru Building. So from 2021 is 0.27. The payout ratio was 27%, meaning the company distributed 27% of its profit as dividends to shareholders. For 2022 is 0.69. The payout ratio significantly increased to 69%, suggesting a more substantial dividend payout compared to 2021. And for 2023 is negative 0.51. The negative ratio of negative 51% indicates that the company paid out more than its profit in dividends, which could mean the company utilized the reserve or took on debt to fund the dividend. Next is for the Ecovest Berhad. From 2021 is 8.32. The payout ratio was exceptionally high and 832%, meaning the company paid out more than 8 times its profits. This could be an unsustainable payout relying on reserve or external financing. And for 2022 until 2023 is zero. No dividend was paid in 2022 and 2023, suggesting a suspension of dividends during these years, potentially due to financial restructuring or a lack of profit. For the AME Elite, from 2021 until 2023, is the payout ratio remained relatively stable over the 3 years. 22% in 2021, 24% in 2022, and 22% in 2023. This suggests that AME Elite consistently paid out a modest portion of its profit to shareholder. And the last one is for WCT Holdings from 2021 until 2023. The dividend payout ratio remained zero across all 3 years, indicating that the company did not distribute any dividend during this period. possibly due to financial constraints or reinvestment strategies. I will explain for the PE ratios that the companies provided for the years 2021 until 2023. So for Mohiba Engineering, from 2021, their PE is negative 1.12. For 2022, their PE is negative 0.18. For 2023, their PE is negative 0.70. A negative PE ratio indicates that the company is reporting a loss rather than earnings. Mohiba Engineering has consistently posted negative earnings during these years, showing that the company was not profitable. The negative value are improving slightly from 2021 until 2023, suggesting a potential reduction in losses but still negative overall. For Fajar Baru Building 2021, their PE is 0.04. For 2022, their PE is 0.17. For 2023, their PE is negative 0.19. Fajar Baru Building had a very low PE ratio in 2021 and 2022, showing low earnings relative to its stock price. The PE ratio became negative in 2023, indicating the company reported losses for the year. This shift to a negative PE suggests a decline in profitability of financial troubles. And then for the Ecovest Berhad, for 2021, their PE is 0.25. For 2022, their PE is negative 0.09, and for 2023, their PE is negative 0.08. Ecovest Berhad had a positive but low PE ratio in 2021, which is shifted to negative values in 2022 and 2023. The negative values suggest that the company has been losing money in recent years, and the low figures indicate minimal profitability or possibly challenge in its business operation. And then for the AME Elite, for 2021, their PE is 19.78. For 2022, their PE is 14.91. For 2023, their PE is 10.29. AME Elite has a consistently positive PE ratio, which is typical for a profitable company. However, the ratio has been decreasing over the years, indicating a reduction in the stock price relative to earnings. A decreasing PE ratio could indicate that the market is less optimistic about future growth, or that the company's earnings are growing at a slower pace. And then the last one is for WCT Holdings. For 2021, their PE is 13.19. For 2022, their PE is 10.03, and for 2023, their PE is negative 5.07. WCT Holding had a positive PE ratio in 2021 and 2022, suggesting profitability. However, in 2023, the PE ratio turned negative, indicating the company faced losses during the year. This change suggests a significant decline in earnings or an event that caused the company to report negative earnings, which likely affected investor confidence. So for the conclusion is, the years 2021 to 2023 have been challenging for most of the companies under review, with Mohiba Engineering, Fajar Baru Builder, Ecovest Berhad and WCT Holding experiencing period of financial instability. Only AME Elite has maintained a stable albeit declining growth in earnings. For this company to regain profitability, they will need to reassess their operational strategies, adapt to changing market conditions, and possibly restructure to achieve sustainable growth. Moving forward, investors should keep a close eye on any recovery strategies this company might implement to reverse negative trends and restore their financial position. So that's all from our group. Thank you.